If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe, but I can't bury my head in the sand and ignore all the facts. And the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead at some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, this is what happens when globalization breaks down. And why Barron's wrote, secure U.S. supply chains with allies and move out of China. Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns. And suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that the economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my super collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden Bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune, secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms, have liquidity and spendable wealth without using Biden Bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance state coming during the economic supercollapse. Biden Bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get Urgent Preparation Report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include There
the
are a
last
lot of
scenario is
difficulties, a lot
collapse,
of
which I
challenges.
actually
We'll
think is
talk
the most
about all of them
likely
in
through a
detail.
combination of wishful thinking,
you put
denial,
words in your mouth,
delay,
you kind of get the
will probably
reputation
just
as
blunder
this
into
doom
a
and gloom
collapse,
guy.
at which point the
Jim
response
Rickards
will
always
take the
talking about
form
the
of
end of the world,
executive orders,
which I don't. I never
social
use
unrest,
that
probably some
expression.
kind of
But I make the point that,
neo-fascism.
despite
Good
the
reason to
difficulties,
believe that we are
we
looking
don't
at a
have to be
potential
victims. We're not
collapse of
helpless. We don't have to
confidence in
curl
the
up in
U.S.
a
dollar.
ball.
And indeed,
The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but
That's
actually
not
make
meant to
money.
be
I
a
always
provocative statement.
point out the example of Hugo Stinnes. And people go, who's that? He was an industrialist in Weimar Germany in the early 1920s.
So this would be the
and
fourth
he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks. That was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar. In other words, he paid it back. He was sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was Inflationskonig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash. But here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. The key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, geez, Jim, you're smarter than everybody else. Of course not. There are a lot of big brains around, but people have flawed models. They have there's a lot of behavioral psychology behind it. The confirmation bias or believing the future will resemble the past, which it usually does not. And so if you can stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic. But the science of complexity, understood in mathematical terms, really goes to kind of the early 60s, but it's been used very successfully in physics.
How the SDR is already
National Laboratory worked with
the United States Treasury got
it has a lot of applications.
to provide
$100 billion to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex
so what did the IMF do with the money?
Well, what they did there's nothing more complex than the human
if you look
brain.
at the total
So you're
IMF
putting
loans,
humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're going to get it wrong.
Third outcome is the gold standard. I'm just going to go through this very quickly.
Came into long-term capital management in 1994 before the launch. So it was
you have to ask yourself a couple questions when you set up a gold standard. The first one is, what's your definition of money?
But I was the lawyer, and I'm not washing my hands of the risk management and all that.
So you have to pick
side by side with these guys.
The second one is, what's the proper reserve ratio?
Nobel Prize winner in economics, co-inventor of the Black-Scholes formula, which is the basis of $1 quadrillion in notional value derivatives in the world. By the way, for people not familiar with the keyword, 1 quadrillion is 1,000 trillion. So that's how many derivatives, off-balance sheet derivatives we have. But Myron invented that formula that set the base of all of it. Really nice guy. I understood in my desk. He'd walk in, had a whiteboard. And I would ask him some dumb question about the markets. And he would sit there and give me like a 2-hour tutorial. So can you imagine getting a private 2-hour tutorial from Nobel Prize winner? So yeah, I was around when there weren't that many of us, but I was sort of a lawyer, very focused on that, compliance, contracts. I wrote the derivatives contracts, so I was very immersed in all that. But I was kind of comfortable putting my money with the firm and putting money I'd made previously. Even the guys who didn't win the Nobel Prize, they won 60
they have
they were the real deal. They were,
one
of them was the youngest professor, youngest full professor in the history of Harvard University, and the vice chairman of the Federal Reserve. 2 Nobel Prize winners, J.M. John Meriwether was legendary on Wall Street. So that was the crowd. So I was at ease about the money.
China is not transparent, so my job.
And then when it all fell apart in 1998, I always say in the U.S. system, it's true in the U.K. also, when things really go bad, they hand it to the lawyers. So like, hey,
so the first one,
I can't do
global money, global
it to the lawyers. And so
40%
it could be a
backing, that's
bankruptcy
about
trustee. We did not go into
$7,000 an
bankruptcy.
ounce. You know, that's what the price of gold would have to be
expert,
to support the money supply
many people
without
especially.
deflation.
So I got the whole
so it's
thing
the
handed to
non-deflationary
me, and then we
price of gold.
organized
Global
it,
money
got
supply,
through
global
it.
M2 with 100%
We
backing
were
is
able to film the
$44,000
runways.
an ounce. The last scenario is collapse, which I actually think is the most likely through a combination of wishful
we were
thinking,
hours away from closing every exchange in the world sequentially.
Probably just blunder into a collapse.
Got a term sheet on a Wednesday, 5 days. Nobody slept. Nobody slept. In big law firms, I was working. We had a base at Skadden Arps. My office was up in Greenwich, but I was back and forth. So the first day everyone looks like a lawyer. Second day the ties come off. Third day the jackets come off and the shirts are unbuttoned down in the middle of the chest. No one's showered or bathed or whatever, and it just gets grubby. But you sort of power through it and get it done. And we did it late on a Sunday night before Tokyo opened. But if it had fallen down and it came close, Tokyo Stock Exchange would have been closed, and then Singapore and Paris and London and New York, they would have probably reopened a few days later, but it would have been a shock like nothing since the Great Depression. So, but the problem is we did get through it. And two things. Number one,
what's actually going on is
24 years ago, so people 25 years ago almost. So people kind of fuzzing on it. If you're under 40, it's probably like a footnote in some economics book or whatever. But we were canceling each other out. But it's not stable. You've got these two forces, and one of them is going to prevail. It's going to snap. We kind of got through it all. I mean, interestingly, some of the principles after long-term capital, you pick yourself up, you dust yourself off. They started new companies and made $1 billion. So they had the talent. We just had a very bad patch. But I sort of looked at it myself and said, well, wait a second. These people really were who they said they were. They really were that good. And yet they had this disastrous outcome.
I go to the bar
massive failure risk management. They're not dumb. They're not venal. But they must be doing something wrong. I don't mean in the moral legal sense. I mean, there must be something wrong in the model, in the way they understood markets, or you wouldn't have ended up that way. So I sort of, I continued my career.
My money has
stock exchange after that.
So, and I remind people $3 trillion times zero. In other words, if you don't have velocity, you don't have an economy. So basically, money supply, how much money is there?
Just kind of on my own time, in my own way, I started exploring what could be wrong with the models, what assumptions were odds with the facts, how did models actually, how did markets actually work, and what models did work. I started writing on that, lecturing on that, and because of my national security work, I got tapped to go out to Los Alamos National Laboratory, and you're actually doing right now, good luck getting in. That's harder to get in than any other place I've ever been. But sort of Mesa, working with people who are simulating nuclear explosions in computers, supercomputers, because you can't.
The first is negative real rates. Negative real rates is when inflation is higher than the nominal rate. That's good because if you're a borrower in that world, you actually pay the bank back in cheaper dollars.
So it's interesting. I would say something. I did say this. I would say,
so ideally, the Fed would say, well, 2% on the 10-year note and 3% inflation, negative real rates of 1%. That's a very powerful investment to go out and borrow. The other thing they want to do is deliver an inflationary shock. If I promise you 2% and I deliver 2%, there's no change in behavior.
And the physicists were like, great idea. Let's put it together. Let's make a proposal. Let's get the funding. They love that. But you would go to an economist and say, well, would you like to join this team? They would say, well, you have nothing to teach us. Why would we want to work with
do whatever? So that changes behavior. So 3%
interestingly, the biggest impediment to improving economic science were the economists themselves,
interest rate,
because they're so
drenched
and
it's also inflation
marinated, I guess, in their own models, most of which are mistaken.
The idea of 3% inflation is to get the borrowing, lending, and spending machine going again.
I just started
getting nominal
building
GDP
my
back
models
to
and
trend,
working
make it
with
self-sustainable,
teams. I
draw
started
policy,
companies
substitute
that
real
do
GDP
that
for nominal
now.
GDP,
So
get real
I've had a lot of
GDP
success
back
with
to
it.
trend, and we all live happily ever after. This is what the Fed is trying to do. They're going to fail, but it's important to understand what they're trying to do, why they're trying to do it. Then when you see them failing, it's very easy to forecast monetary policy because they're just going to do more of it till they get what they want. Why do they have to get this? Well, why do they have to have inflation? What's wrong with a little deflation? Well, here's what's wrong with it. This is actually the Fed's worst nightmare. The government, in economic theory, inflation and deflation, prices are going up, prices are going down. So what? You get a raise or you don't get a raise, or you get a little benefit, or they're winners and losers. It would seem like a normal economic process. But the government's view of inflation, deflation is asymmetric. They have to have inflation. They cannot have deflation. They can't tax it. So imagine you make $100,000 a year and your boss gives you a $10,000 raise and prices are constant. Okay. So you just had a $10,000 increase in your real standard of living. You got 10,000 more and prices are the same. Except what happens? Well, the government comes along and takes half. They take 5,000 and you get the other 5,000. But imagine an opposite case. You're making 100,000 a year. You don't get a raise, but prices drop 10%. Well, you had the same $10,000 increase in your standard of living. Your salary didn't go up at all, but the price of everything you buy went down, so you're better off. Except that now you get to keep the whole $10,000 because the government doesn't know how to tax deflation. So deflation can increase the real standard of living of the American people, but the government won't allow it because they can't tax it. It destroys tax revenues. Supply chain is not part of the economy. Supply chain is the economy. In other words, if you want to understand the economy, you're really talking about the supply chain at every aspect. Something as simple as a loaf of bread. You buy a loaf of bread at the grocery store. Like, okay, well, I guess it came from a baker, and I guess they took it from the bakery to the store by truck. So there's a supply chain. Well, that's about as simple a version of the supply chain as you can imagine. You have to just start going from there. It's like, well, did the bread come in a plastic wrapper or a paper wrapper? Well, that wrapper came from somebody. Where'd the truck come from? Well, obviously a truck manufacturer. Where'd the driver come from? Somebody had to make a career choice and be trained. And what about the diesel fuel in the truck? That came from a refinery, and that came from oil exploration. Then you get back to the baker, and it's like, oh, well, I guess he had an oven or she had an oven. Where did that come from? And then you find out that the ovens are industrial ovens have parts from 25 different countries and so forth. Well, without belaboring that point, you get back to the farmer and the wheat and the fertilizer and everything else, and really what's called the extended supply chain. And you're like, wait a second, that's a huge number of countries, a huge number of imports, and a big part of the economy, which it is. And then every link in that supply chain I described has its own supply chain behind it to get to source materials and intermediate manufacturing and so forth. And then that's for a loaf of bread. Well, what about your car, your furniture, your clothes, and on and on and on. Once you start thinking about what supply chains are, you realize it's just the cardiopulmonary system of the entire global economy. So, the supply chain book shines a light on the entire global economic process. And I have whole chapters on that talk about China, the war in Ukraine, and climate change. And you say, well, the interesting topics, but what do China, Russia, and climate change have to do with the supply chain? Well, the answer is they are, kind of global macro earthquakes. Russia's invasion of Ukraine led to sanctions against Russia that affect everything, imports, exports, strategic materials, semiconductors, fertilizer, oil, natural gas, etc. Again, you're saying, well, okay, Boeing makes aircraft. They need titanium and aluminum. Where does that come from? Turns out about 30% of it comes from Russia. So how are you going to keep the Boeing assembly line going when you're shutting down strategic metals from Russia? I can go kind of on and on there. China, everyone says, well, they slowed down because of the zero COVID policy. And that certainly has been detrimental to their economy. Shanghai, a city of 26 million people, Beijing, a city of 22 million people, they were both locked down entirely last spring. When I say entirely, no transportation in or out, nobody on the streets. You had some essential workers, people had to get to work. You had to have a COVID test, a negative result that was not more than 2 days old. So these were extreme lockdowns and obviously very, very detrimental to the economy. Now, those have died down a little bit, and China's saying, now we're going to relax our zero COVID policy a little bit. So what's new? Why are supply chains breaking down? What's new about the supply chain that makes it different than any other period in the history of the world? And what's new were two things, and they arose around 1989. The first was you had a combination of increased computing power, algorithms, artificial intelligence, better data collections, and new models. So you suddenly had the computational telecommunications and data and mathematical tools to be a lot more sophisticated about how you handle the supply chain. But the second thing that happened at the same time was 1989, the fall of the Berlin Wall, 1991, the collapse, demise of the former Soviet Union, which gave rise to new trading partners in both in Eastern Europe, where they were no longer behind the Iron Curtain, Poland and Romania and Hungary and many other countries. And at the same time, you had the rise of China. China did have a fairly high growth period in the 1980s, but
nothing like we see today. And it all came crashing down in 1989 with the Tiananmen Square massacre. And that really shut down U.S.-China relations, not fully, but there was no Western investment coming into China. The two countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math, and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. They both made it worse, no doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics, just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts, and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date with a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0, but we're not there yet. We're in this messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years, or maybe longer, to rebuild in some form. The first point I would make is that global recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, the 1970s used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had 3 recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it, okay, and certainly in 2020 during the pandemic lockdowns. But they're unusual, as I say. It's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way. I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned. Because as I say, the Fed's going to over-tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another. And this will just be the latest in a long series. And so just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where a severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah. But you have 1,000 trillion of derivatives. And they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year Treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days. But there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge. It's by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the U.S. dollar is so strong. People go, wait a second. The U.S. has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets. What's driving the demand for dollars is the need to get dollars to buy dollar-denominated collateral, specifically treasury bills, to post as collateral to support the $1 quadrillion of derivatives. And that's going to persist until the system crashes, which it's in the process of doing. Now China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing 8,000 tons, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's not transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently or others around the world. But central banks sure do, and I think that tells you something. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023, and no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
And then they ramp up the printing press again, Jim.
Yes, but it doesn't work. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor, as a bank, I think of it by weight. Because when someone says gold's really going up, I said, well, no, the dollar's going down. You need more dollars to purchase a fixed quantity of gold, which means the dollar's worth less. And when people say gold's really going down, I say, no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. When people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever? And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight, and then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up. In 1914, when World War I started, all the major powers went off the gold standard. They said, we got to keep our gold. This is real money, and this is how we're going to win the war. And the Bank of England was faced, and the Exchequer was faced with the same choice. Keynes was an advisor to the Exchequer. He said, don't go off the gold standard. Stay on the gold standard. And the reason was that if you did that, you would preserve your reputation and preserve your credit. He said, the war is not going to be won with money or gold. It's going to be won with credit. But if you stay on the gold standard, you'll have the credit. And that's exactly what happened. Jack Morgan, Pierpont's son, organized huge loans for England and France and nothing for Germany. And England won the war. So the point is, Keynes got that right. Now, flash forward, 1925, he's talking to Churchill, and Churchill wants to go back to the gold standard. And Keynes is telling you got the price wrong. We can't go back at, £4.25 or whatever the exact rate was. We've got to devalue the sterling by half because we doubled the money supply to fight the war. Churchill ignored Keynes's advice, and they went into a recession, depression before the rest of the world. Flash forward 1944, you're at Bretton Woods. Keynes wanted a gold standard. And this isn't speculation. He wrote papers. He gave formal presentations. So 1914 is pro-gold. 1925, he's telling Churchill, you're nuts. You can't go back to a gold standard at this price. 1944, he's pro-gold again. I call that a pragmatist. Supply-side inflation can feed to the demand side. Demand-side inflation can feed on itself. But supply-side inflation alone does not feed on itself. It tends to destroy itself. There's an old saying, the cure for high oil prices is high oil prices. In other words, if you make them high enough, and going back to what I just said about putting gas in your tank, think of all the things you're not spending money on. And that causes business failures, layoffs, higher unemployment, lower velocity of money. You stay home, like you said, you don't go out basically. And that's what's happening now. So we're starting to see inflation come down. When it comes down a little bit from, 8.2% to 7.7%, people go, oh, it's still high. Well, it is still high. But that's a noticeable drop, and we've seen that a couple of months in a row. What's going to happen faster than markets and investors expect is that this inflation is going to come down so fast, it's going to be a strong form of disinflation. Now, disinflation is still inflation, but it's lower inflation. And in terms of response functions, it bears a closer resemblance to deflation than it does to inflation, even though it's still a form of inflation. When inflation is coming down, what else is going on? Well, real interest rates are going up, and the economy is slowing down. And then it could even tip into deflation. That would be a shock to the system. And in that world, cash is your best performing asset because the real value of cash actually goes up in deflation when everything else is crashing around you. So So yeah, we're in inflation right now. It's painful, but it's starting to fade more quickly than people expect. And my forecast, based on a lot of analysis, and it's all in the book, sold out, is that this disinflation, borderline deflation, will prevail. And by really just in a few months, January, February, March 2023, if not sooner, we're going to be in a very severe recession. And people are going to be surprised at how quickly inflation comes down, and they won't be positioned for it in terms of their portfolios. I mean, for example, a 10-year Treasury note would be a very good performing asset in this world, because yield to maturity on 10-year Treasury notes has been recently 4%, and now it's around 3.5%. That could come down to 2.5% in a heartbeat, even lower, and that would produce huge capital gains. So it's a big deal for investors and asset allocation and portfolio management, and a lot of people don't see the disinflation coming. The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months. And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important, because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how the cost push inflation tips into a recession, and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull. We have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is the cure for. It's coming. I mean, the recession is coming, and Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi, he tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it, get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins, the dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control. I mean, and what Powell said, he didn't say that their target is core PCE, personal consumption expenditure, price index, core meaning excluding food and energy. And everyone's like, why would you exclude food and energy? Again, I'm not here to debate it. That's what they do. So they want to get core PCE year over year to 2%. It just came in at about 4.7, give or take. It just went up. I mean, it's not going down, but they're trying to get it down. Now, Powell did not say we're going to raise rates until core PC is 2%. He didn't say that. What he said was we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. At which point we, the Fed, will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, they've got to get rates high enough. So they're going to go, who knows, we'll know closer to the date. Some talk about 50, but it doesn't matter. I mean, it's going up, probably going to go up. You know, I have the calendar for 2023. There's a meeting in March, I think March 22nd. They're going to get rates up to five-ish. It's like I remember in Vietnam, the old saying, you know, we had to destroy the village to save it. We have to destroy the economy to save it. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. And then beyond all that is there's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. The Fed will give you treasury bills with a phone call. All you have to do is call the Fed and do a reverse repo with the Fed. They'll give you some treasury bills. But the banks are bidding at auction for treasury bills that yields maturity lower than what the Fed will give you for a phone call. Why would you do that? The answer is the Fed bills cannot be rehypothecated. They cannot be used as collateral, but the auction bills can. So what that tells you is there's a collateral shortage. That means deleveraging balance sheets. It means financial distress. And we also see it not just in the treasury yield curve, which is inverted from right now 6 months to 10 years, but also the euro-dollar futures curve, which is even more troubling. It's not unprecedented, but it is rare, and it's not a good sign. But the Fed continues, raising rates in the teeth of this really bad data. So I look for a severe recession in the U.S., really global, because it tells the global outlook is pretty bad. And then on top of that, possibly a global financial liquidity crisis worse than 2008. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the euro-dollar futures curve and the treasury yield curve, and negative swap spreads and treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening, and the fundamental signs are also weak, which we saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? That's not sustainable. So I would look for a recession, a more severe recession. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector. And I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. You pretty much wait until the recession has already started and you can, all right, I got to lay some people off. So it's not a leading indicator. It's a lagging indicator. So the Fed is behind the curve. We got through 1998, we got through the dot-com crash, we got through 2008, we got through 2020 and COVID. There's actually a good size market drawdown in 2018 between October 1st, 2018 and Christmas Eve, what I call the Christmas Eve massacre. Stock markets dropped 20% in under 3 months when the Fed kept raising interest rates, even though the economy was weakening. So they have seen those, but every single time it came back, even in COVID, March, April 2020, the stock market went down 30%. It did. I mean, just almost straight down. But by September, we were back to new all-time highs. And so it's not that they've never seen that kind of volatility, but they learned the wrong lesson, which is it always comes back. And we know why, because the Fed bails you out, the Fed floods the zone with money, the Fed talks it up, et cetera. But the counterexample in 1929, when the stock market did crash, it was down 23% over 2 days. It was like a 12% day and an 11% day in late October 1929. But it kept going. The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%, not 30%, not 40%, down 80%. And what people don't know, many people don't know, is you said, okay, then it rallied in 1933, 1934. The Fed messed up again and blundered again, as they usually do in 1937, and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was 1954 before the market recovered from 1929. Now, it doesn't mean there weren't gains along the way or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. And the point is, you need to be prepared for things like that. And there are no one alive, but very few people alive have seen anything like that. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and, print some more money and do the same thing over again and bail out the new failures, whoever they may be? You can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before. And that's the point. You can go all the way back 1994, Mexico, 1998, Russia, LTCM, 2000 dot-com, 2008 Lehman, 2020 pandemic. And they do bail out, but each one's bigger than the one before. I mean, we threw out $6 or $7 trillion of new debt on top of a $1 trillion a year baseline, $7 trillion in new debt to kind of dig our way out of 2020. So there is a limit. There comes a time when it's like, hey, this bailout is going to be 20 trillion, sorry, that check's too big. We're going to have to let some things fail. So what could happen? The first thing on my list is we're heading for a very severe recession. I just want to kind of explain briefly the dynamics of that. So the Fed's raising interest rates. We know that. They started, it wasn't that long ago, but March 1st, 2022, the Fed policy rate was zero. It was 0%. People remember Paul Volcker. Oh, Paul Volcker raised interest rates to 20%. Well, he did, but so far Powell hasn't raised them as high. But he's raised them fast. I mean, even when Volcker was working his way to 20%, it took 3 years, from 1979 to 1982. So Powell's plan is clear because he's told us. He said inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up. And too bad. It's kind of too bad because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. And the pause could be a year. And Powell said this. Again, this is right out of his script. So Powell's in search of the terminal rate. By the way, if you said to me, hey, Jim, what's the terminal rate? I would answer truthfully. I would say, I don't know, but neither does Jay Powell. Jay Powell doesn't know what the terminal rate is. He's kind of saying, we'll know it when we see it, but we're not there yet, and we're going to keep going. And they have what they call the DOTS, silly name, but the members of the Board of Governors and the Federal Reserve Bank presidents give estimates, or their estimates of unemployment, inflation, growth, and interest rates for the next 3 years, and they put them as dots on a chart, so they call it the dots. And then, Wall Street gets the dots. They do a central tendency and regressions and all this stuff. One of the top Fed insiders, like, practically sits in Jay Powell's lap and has all the way back to Bernanke and Yellen, told me personally, he said, inside the Fed, they regard the dots as a joke. They're not better than guesses. Their forecasting ability is dismal. You or I would have better forecasts, and they wish they could get out of it, but they don't know how. So that's the truth. But the problem is, Wall Street and the financial media and the talking heads on CNBC, they want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side, you're going to get run over. So I look at the dots not because I put weight on them as predictive analytic tools, but because the market pays attention. The market says, hey, inflation's already coming down. And so the market says, hey, you did it. You're already there. Inflation is coming down. Why don't you stop? And by the way, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. And then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out. The Fed's going to cut rates, and so buy stocks. That's all Wall Street knows, is buy stocks. But the conundrum is inflation coming down because the Fed is still hiking? Or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far. And it's not going to be a mild recession. It's not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far, as usual. And you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far, too long, rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his guns and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, say, yeah, Powell means it, he's going to keep, and we ought to come down a little bit, that would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen. They're not listening, and it is going to happen.